Hello and welcome to Bondcast, a podcast series where we explore current themes and events shaping rates markets. I'm Giles Gale, head of European rate strategy, and I'm joined today by my global market specialists, Ross Walker and Jan Nevruzi. And we're going to start with Ross, because you are our head of, economics, but also UK specialist. And we had the Bank of England today, where everybody expected a quarter point hike. So, really, that was delivered. But the attention was really there on the guidance. And so maybe you could just explain to us what we got there.
Yes, very little change on the guidance. It was really a carbon copy of what they published in March. So namely, there's still a hawkish bias there. They're referencing persistent inflation risks, and therefore, if required, the possibility of further monetary tightening. Ahead of this meeting, we thought there was a possibility they might nuance that a little, maybe make it a little bit more symmetric. The fact that they haven't, I think, will clearly shore up market expectations that there's at least one more rate rise to come. I think we're still a little bit skeptical. We sort of lean towards the current 4.5% rate being the peak, partly because there is still a lot of policy tightening working its way through the pipeline, those previous bank rate rises that have yet to reach mortgage borrowers, but also the data flow over the next few months. We think we will see, certainly in terms of headline CPI, quite a large drop. And we think that will begin to give the Bank of England a little bit more leeway. Also, bear in mind, the next meeting in June is not a quarterly forecast round. So that maybe lessens the probability of a hike coming that month. If there still is upward pressure on inflation, it could come a little bit later at the August meeting.
Okay, so I guess then the question is, where that leaves us, and what would determine, what's going to be the determinant for their decision whether or not to raise rates again at the next meeting or in the near future.
Yeah, so a lot of this is centering on the labour market, and both the minutes and the monetary policy report today did acknowledge that there is evidence in some of the high frequency survey indicators that we're seeing some loosening in labour market conditions, albeit from a fairly tight starting point. But you can see hiring intention surveys cooling. We can see vacancies coming down a little bit. Some of the wage inflation surveys are suggesting maybe a leveling out. But our starting point, at least in terms of the official wage data that we had a few weeks ago, was that there was both a higher level of wage inflation and in the near term, a little bit more upside momentum. So certainly I think the next labour market data that we'll get in a week or so's time will be very important. The data that come a month after that will stretch to April, which is the single most important month for wage settlements. So I think that's another reason to think that maybe from here, even if there is still an upside bias, an upside risk for the bank rate, there are going to be over the next few months several key data releases, and maybe the MPC will just want to take a bit more time to assess the inflationary outlook once they have those labour market figures for April, and once we see in the CPI data, we're beginning to see big downside effects from last year's energy shock.
All right, and so Bill, thinking about those things, what is it about your view on those triggers, I suppose, or the key themes that leave you still below the consensus on the peak for the trajectory, let's say, for the Bank of England?
So I think the inflation. One of the other features of the inflation report forecast is that the very high degree of uncertainty around the medium-term forecasts, and in a sense the lack of conviction and signalling around those projections. So the BOE has become inevitably much more data dependent in the near term. The other feature of the forecasts they published today in the May report is that the interest rate profile that underpins those is for a little bit more tightening in the near term, 40 basis points, 50 basis points or so up to a 4.75% peak. But then relatively quickly, and through 2024 and 2025, over 100 basis points of rate cuts. And in many respects, that feels like quite an extreme profile. Why would, in a sense, you over tighten in the near term to have to relatively quickly engineer a series of rate cuts, possibly starting as soon as the end of this year or the very beginning of 2024? So a lot of the signaling is complicated, and the implied policy reaction function, I think, that's increasingly priced into markets doesn't seem entirely credible. I think either there's a much bigger inflation problem and they will have to continue tightening and perhaps take rates above 5% or leave rates at a higher level for longer. Or there isn't. They've done enough. They can be more patient. They'll just allow the pass-through to work its way through and eventually restrain consumer demand. But this idea that we get this more aggressive near-term tightening and then a speedy U-turn doesn't feel very plausible, and I don't think it would necessarily be a particularly effective form of monetary policy.
All right, thanks very much, Ross. So, Jan, I think we go to you now, where I guess since the Fed, we've had two pretty significant sets of data, in fact more than that, but maybe starting with the Senior Loan Officer survey, this famous SLOOS, which I didn't realize anyone called it that, but I did learn that last week listening to you going over it. So maybe you can give us a little rundown about what was in that.
Yeah, the SLOOS did show that lending standards for banks did indeed tighten. We did see a move up in banks responding that they will be tightening. They will they'll be requiring more stringent standards when they're making loans, particularly in the commercial real estate sector, where the percentage of banks reporting that standards will be tightening went up to like 68%, which is not too far off from the previous crises of COVID and the GFC and the dot-com burst. Additionally, we saw a substantial decline in all sorts of demand for loans, both from the commercial side, but also from the retail side. So expect lower, not just harder loan origination, but lower demand for them from both consumers and businesses. As a rule of thumb, we have in the past pointed out that something like 25% tightening in standards for commercial industrial loans tends to lead to about a 1 percentage point drag on real GDP in the subsequent quarter. Looking at the past few releases, we estimate that should lead to about just under 2 points of drag on GDP for Q2 and Q3. But given the broad-based tightening in standards across not just CNI, but also all the other categories, we think the risks to the downside in the economy are actually larger than that rule of thumb that I just spoke about. And all of this brings us back to our point of why we see the economy slowing down later in this year, right? Like for us, credit and the slowdown in credit is a major component of not just how the U.S. economy operates, but as an engine of growth in the U.S. And we think that will allow the Fed to kind of pivot into the end of this year and start cutting rates. Okay,
so I guess the other big one, and it really is a big one, is the CPI, and I suppose maybe as a little bit of a follow-on from that, markets are reacting today to the PPI. So maybe you want to take a discussion of both of those together, or just talk us through how that looked to you.
Yeah, and I think it's worth focusing more on CPI because historically, when we talk about CPI, we refer to consumer price indices as opposed to PPI, which is the producer side, a lot more influenced by input goods like commodities. And PPI in the past has shown relationship of leading CPI because it's the first kind of like from upstream as it moves into the consumer basket. That relationship has broken down throughout COVID. It might resurface again, but it does have implications for the Fed's preferred measure of core PCs, so like the personal consumption expenditures index that they use to gauge inflation. However, the CPI, which tends to be the more market moving release between the two of them, showed a 0.4 increase in both the headline component, which contains both energy and food, and in the core side, which strips out energy and food. That brings the year-on-year reads for the headline from 5 to 4.9%, and for the core to 5.5 from 5.6%. So we are seeing a move in the right direction. At least we definitely did not see the pickup that some people were looking for, fearing more so that would require the Fed to come back more forcefully and just kind of end up realizing the nightmare scenario of inflation showing a deceleration, then come right back again. It's too soon to say we're out of the danger zone, but signs are encouraging. Digging a little bit deeper within the CPI, the core goods basket did increase by 0.6 on the month of April. However, the entirety of that increase can be attributed to increases in used car prices. Those are not just very volatile, but they increased, or the component within CPI increased by 4.4% on a monthly basis. We have been expecting that increase to come at some point, given other car wholesalers have reported a similar increase in their inventory sales. But that has been a pretty short-lived 2-3 month type of stint, and we do expect that the lag has kicked in, and we expect used car prices will keep falling down either next month or soon after that. If you don't look at used cars, and I'm not going to kind of go do this exercise where we strip out component by component from CPI and eventually end up with zero inflation, but core goods were actually unchanged on the month if you excluded the used cars. With them, 0.6. And finally, core services advanced at 0.4 for the month of April. That's a second straight month where we're seeing a 0.4 increase, and comes after 0.6s in the months before. That deceleration is certainly welcome, and the rental sites and rental and shelter it remained at 0.5. Actually, rent did tick up slightly to 0.6, but it is below the 0.7, 0.8 numbers that we're seeing earlier in the year and late last year. Lodging away from home, so think about hotels, those show decreases in prices. Airfares show decreases in prices. So 0.4 is good, moving in the right direction. We're looking for further deceleration, particularly as rentals slowly continue to drift lower. But finally, what does that mean? Well, it doesn't move the needle all that much for core PCE that the Fed is looking for. Perhaps the PPI today added a little bit of upside pressure to given which components are going to be used into PCE, but it didn't really change the needle that much. It didn't, markets were, the Fed pretty much indicated that they're going to pause in June, and this report didn't give us anything to question that. If anything, markets on the back of, not just inflation and PPI, but also everything that's going within the banking sector and Western and global central banks have been pricing more and more rate cuts sooner. As I was walking through this room and left my computer, the last reading showed about 45% of cuts priced in of a single cut priced in for July, which is a substantial premium that the market is extracting.
So I'm just looking at the pricing for the Fed that's got 110 basis points or something like that in for rate cuts by January next year. Now I know that you've been more on the bull side, and I think you still like steepeners and so on and so on and so on. So I just wonder, given everything that you've said, how you feel about that, and how you sort of fit that into that whole you're thinking about the whole curve here.
Yeah, I think we do see a path to cuts by the end of this year. I mean, we have penciled in 50 basis points right now, but risks are certainly to more cuts than not in our view. Even though our core PC forecast for the end of this year is 2.9%, the path to how you get there is very important in our view. You're going to realize, we think, 0.2s and maybe the oddball 0.3s on a monthly basis. If you annualize that, you get something close to the Fed's target. Plus, unemployment is going to be, we expect unemployment will be ticking up substantially by then. We are looking for a 4.2% by the end of this year. So that kind of environment, alongside everything that is going within the banking system, and fragilities have been exposed. We simply don't know if there's anything else also lurking there. We know that unexpected risks are there. well, by definition, they're unexpected. But it will be in our mind very hard to price out those insurance that the market is pricing in for the end of the year in terms of rate cuts. But yeah, we could see cuts happening earlier and faster, and think the macro backdrop will allow the Fed to pivot. Yeah, so to summarize what I was saying, we are looking for cuts by the end of this year, and we think by the end of this year we could be having an entirely different conversation about the future of inflation. But in Europe, perhaps not as exciting as the CPI or the Bank of England, but there were some ECB speakers. Do you want to walk us through what we heard and what was new in that from the speeches?
Yeah, fair enough. I think we're leaving the least till last this time around. We obviously had the ECB last week, and ECB speakers come out and they tell us what they think. But I mean, there's not an awful lot for them to go on compared to the information that they had towards the end of last week, to be quite honest with you. So it's just, we're just refreshing where everyone stands and what kinds of things they think are important. And lo and behold, they're the similar sorts of things that they've been talking about in recent weeks. So we had Villeroy. He's still on the dovish side. He's talking about there just being a marginal distance left for them in this hiking cycle. So I think we know where he stands. I've always thought of him as being sort of quite the influential sort of swing member, if you like. But he definitely seems on the dove side at the moment. We've had Nagel, who was talking this morning, a little less hawkish, I suppose, in the sense that he's sort of in line with the guidance that Lagarde chose to give at the meeting last week. So, he was talking about, maybe 2 more rate rises, possibly 3, talking about September being still live. So, that's his emphasis, I would say. He's sort of in the pack there. We had Schnabel. She gave a speech, and this is this lovely innovation that the ECB has recently instigated to avoid, I guess, somebody making a transcription or too much stress on people's typing fingers and everybody else's reading eyes, because they just give us the charts. They don't give us the full text, which means we don't get to page down to the end to see what the monetary policy conclusion is, but we have to kind of infer it from the charts that they choose to show. And as I look through that, what do I see? It's a little bit of a mixed bag. One of her first charts was just highlighting the fact that CPI, at least with the April flash, it appears to be realizing just a tiny bit higher than the March forecast round. So you might take that as a little bit of a hawkish signal, but at the same time, there's plenty of recognition that some, at least, of the many measures of underlying inflation that they track are turning over. Even those famous momentum indicators, which are all high, but they are, or many of them are, at least turning over. It's a bit like the guy who looks up into the sky and sees, can spot a dip. But there is a little bit of that there. But broadly speaking, it's still too early to tell how our call, which is that the ECB actually stops after just one more hike in January or in June, to really know how that's tracking. There's a long road and a lot of data before we get there.
Yeah, and let's wrap it up with some ratings updates. Italy has one coming up, and do you think that will lead to more distress in the markets, or all is clear?
Yeah, well, it's a good question, and we were talking to lots of clients, you and I, this week, and that was one thing that European client base, I would say that the level of conviction and inspiration out there was on the low side, and this was just one of the sort of tactical things that came up several times, because Fitch downgraded France after having them on negative outlook a couple of weeks ago. and they are coming to a review of Italy on Friday. And so, I mean, people sort of noticing that Italy's been widening. It's now sort of towards the wide end of its range and spread, and wondering if maybe there's a little bit of a story here to push Italy to a new, perhaps somewhat wider range. And I would say I don't see it, frankly. France was, I mean, amongst other things, it was already on negative outlook. If you go through the Fitch reports, you can see that, for example, the peer analysis, France is France. I mean, it has institutional strengths which are undeniable, but when it comes to the hard debt metrics and the kinds of things that they would normally base a report on, it did not look very good, and so on almost any compared to its AA peers, right? So take that to Italy, and the comparison with the BBB peers. I mean, it actually looks in line, probably better on most of those. And compared to November, when they went through the last review, the things that really matter, that is the deficit projections, the debt to GDP level and trajectory. Those and growth, by the way. I mean, they had projected back then a recession in 2023 for Italy, and clearly that is no longer tracking. So all the important metrics seem to be better. So overall, I don't see the story here personally. And as I've repeated in recent weeks, I'm still not militantly, but positive. I'm moderately positive on Italy, and I don't think that this is necessarily a major concern. And just to run through other things, I mean, no big changes in other views either, to be honest with you. I mean, we still like being short Europe versus US in the long end. Still like being, I mean, all the positive things I said about Italy. I mean, broadly, you can apply those to other sovereign spreads as well. I think that asset swaps likely tighten, and particularly I think that Schatz looks quite wide compared to swaps, or 2-year Germany, let's say. Now, I quite like the idea. Imogen was talking about being long UK against other countries in the front end. Now, I think there are some questions about the positioning, which a few people have highlighted to us in recent discussion in that trade. But fundamentally, I think that looks that does look compelling. And other than that, it's just steepness for us. So I still quite like the front end steepness. I still quite like long end steepness as kind of strategic trade. I think that there are ways that you can position buyer options and so on, particularly steepening with a bearish exposure. So all similar sorts of things. Let's see where we are next week. So I think that's all we have time for today. And if you've enjoyed today's episode, please do hit the like button to help others to find it, and subscribe. And we will speak to you next week.